Alright, what's up everyone? Welcome back to our channel with Real Money Talks with Season
Alex.
So welcome back. We went live on YouTube with our podcast channel, and we would just want to say big thank you to everyone who took the time to like and subscribe, and
shout out to you guys,
tune in, and all the real people that subscribe to Real Money Talks. Get it? Yeah. With that being said, please provide any feedback, comment down below if you have any questions. We're looking to be we're here every week, right?
Mm-hmm.
We're looking to be here every week and kind of go off on what the market is doing, answer questions. Since we went live on our podcast for our YouTube channel, we kind of asked on our Instagrams and stuff. We kind of asked for feedback. I asked for feedback as well. We got a lot of questions in, and I think that's what we're gonna go. That's what we're gonna do. This is what this podcast is gonna be about. This episode is gonna be all questions relating to our channel and all questions relating to home buying process and or just anything real estate.
Yeah. And more specifically, geared towards that first time home buyer.
Mm-hmm. Yeah. So a lot of people are looking to buy right now, and most of them are first time home buyers. If you think about it, we're in a young generation, so are the younger generation anything from 20 to 30, this is the first time making a big purchase. So.
Even early 30s, the national first time home buyer, I think is 32, 33. So
yeah. So the fact that you're here and taking the precaution of informing yourself is already a great step. You're ahead of the game. So we're gonna go off all the questions here. I wrote them down. What? And the first one that I have here is, how much can I afford to borrow for a mortgage? So, he's the loan officer. He's the loan officer here. So everything mortgages has to do with him. But not a lot of people even know what a mortgage is. So a mortgage is basically a bank loaning you the money for you to buy a home.
I would say it's more of an investment than a liability.
Right.
Only because, so the average one is going to be 30-year fixed rate. Your payment's going to be the same for 30 years. It's not going to change. At least your principal and interest isn't. Your taxes and insurance might fluctuate a little bit here and there. Just depends more on the state and the insurance company that you have. But yeah, so it's going to be a payment that doesn't change. As I'm sure if you've listened to other podcasts, we've already talked about it. For the majority of the time, real estate tends to go up in time. So you're still going to owe the same debt 20 years from now, per se, on that property that you bought for $300, and 20 years from now, it's probably worth $400, $500. So
we can all agree it's good debt. It also has tax benefits as well, so it benefits you don't own a home. Okay, cool. So I'm pretty sure you get the picture of what mortgages are.
Yeah.
So what do I need in order to get a mortgage? How do I know what can I afford? How can I afford? I know it's the number is there, but we're going to give you a ballpark just so you kind of get an understanding.
Yeah. And so for easy numbers, let's say it's somebody that is making $60K a year, has little to no outside debt. If you're making $60K a year, the way we qualify you for a mortgage is we base it off your monthly income. So at $60K a year, you're making $5K a month. If you're going conventional, the max debt to income ratio that you can have is 50%. So we take that $5K a month divided by 2 to get 50%. That's $2,500.
Okay, so that's what you can basically afford as a mortgage payment.
Yes, that's the maximum that you can afford as a mortgage payment.
Okay.
And that's including your principal, interest, taxes, and insurance. So,
HOA.
HOA, all of that.
So all the extra fees.
At $2,500, with the interest rates that are today, I'd say you're looking at, and depending, your rate depends a little bit on your credit score and other things, but let's go based off average rates.
Right.
You're looking at 330 to 340K house. So if you're making $60K a year, you're probably able to afford 330 to 340.
Yeah.
Again, this is averages,
This is getting pre-approved for that ballpark, not including, so that's your $60K salary, right? That's including not having any debts, right? So what if we include a car in the picture?
Yeah.
So let's say most people here, lease a car or they make payments on their car. That brings them down just a little bit.
Yeah. So
but we want to keep it real and tell people that hey, there's some situations you might own a car or maybe have
a couple credit
college
cards or student loans. So, and like I said, that's why it's important to get in front of a loan officer and get your actual numbers. So if we're going based off just base numbers, let's say you have a car payment of $300. another $100 in like credit cards or student debt or whatever the case may be, like monthly payments.
Yeah.
So that lowers you by $400. So that means that now that monthly payment maximum is $2,100 instead of that $2,500. And at $2,100, you're probably looking closer to $300 to like $320. Like so, it lowers your range by like $20 to $30K.
But it's overall, it's still possible.
No, yeah, and that's the point I was gonna hit. Like, it's still definitely possible. To buy a home with student loan, credit cards, and car payments. It's all averages.
Yeah, that's really good because like a lot of people, they're like, oh, like I have student loans I have to take care of. I have this to take care of. Like people can do it all three. Yeah, as long as it fits your budget, which is why the DTI ratio exists, is to make sure you can actually afford. You can still make it happen. Yeah, and I do want to just point off, like, I know previously we kind of hit a little bit on FHAs, how some people don't like them because they have that insurance for the life of the loan. But we've also talked about how they do allow it to go a little bit higher on debt to income ratio. If you do have those debts, FHA, for example, on the back end, which is including all your debts, a lot of times lets you go up to like 56%. So, versus conventional is 50. You can have those debts and maybe still even qualify for that 330 with those debts included because FHA lets you go up to like 56%. So there's a lot of other numbers included, but so far like that kind of like rounds everything up. So it's still possible. Everyone has an opportunity to get pre-approved.
Like, definitely don't feel discouraged if you have car payments, credit cards, student loans. Like, I'll tell you straight up, like, I see more people come through with student loans, credit cards, and car payments than without. The amount of people that have like no debt and they just have their monthly income is like substantially low. And all these people are still buying homes, so don't get discouraged. If anything, like, I had a couple credit cards when I bought my house. I'm sure you did too. So I mean, it's not impossible.
So with credit cards being said, there's this like topic about like how many credit cards should I have? Like, what is good, what is bad? And I think we had a conversation about this earlier. But I personally, I have 3 credit cards, right? And I had 3 credit cards when I bought my first home, and I had 3 credit cards when I bought the next one. Like, I've always wanted another one, but I'm like, I heard it's bad, but I'm learning like it's not that bad. It all depends on every scenario. So kind of want to like.
So I mean, it's a good scenario that he touched on it. Like, for example, I have 10. I honestly probably have more. I don't keep track. I'm not gonna lie.
That's crazy.
But because the point to credit cards is, and this is one of the things that I'm not a financial advisor, so I can't necessarily. So don't take my word exactly for it. But if you have more credit cards, sometimes they can help your credit score because it shows that you can handle more balances and still keep them low and still be responsible. So that's one aspect as to why I have so many credit cards. But I don't necessarily use all my credit cards. Which is what I think you were touching about when it comes to mortgages. When it comes to mortgages and you feel like you're about to get ready to buy a mortgage, it is better to have fewer credit cards with balances. So you don't necessarily have to have less credit cards, you just have to have less with balances. So for example, if there's a feature where you can transfer all your balances to one card, you're better off doing that than having 10 cards with small balances. And I can kind of explain about why real quick. And we'll just do a quick scenario. Like, for me, let's say I have 10 credit cards. Let's say I owe $100 on each of them. That's $1,000. But with a minimum payment of $25 on each. Which doesn't sound like a lot, but 25 times 10, that's 250. That's 250 less monthly that I'd be able to qualify for a mortgage. Versus if I transfer that $1,000 to just one card, my monthly minimum payment on that card, let's say, is like now $60.
$60.
So now I only show $60 of monthly debt versus $250 when I'm still owing the same $1,000. So when it's time to come to get a mortgage, yes, you're way better off having less cards with debts on them. 2, 3 maximum, and try to have your other ones at 0. But it's still okay that you have those other ones. If they show a $0 balance, they're not going to be counted against you.
So folks, kind of to like narrate it all, I would say, if you have 10 cards, you're good to go as long as you have like lower balance on cards. And or have less cards to pay monthly. So or have like 2-3 cards like Caesar
and just play it safe.
and play it safe, which is cool and everything. But overall, like I want to get another card. I'm probably pretty soon. But if I have 10, you just have to be responsible with that. So,
and I mean, and that's one of the good things that we kind of talked about in the last episode is always talk to a loan officer when you're thinking of buying, even when right before you think you're actually ready. Because that's one of the questions that, I can answer. Like, let's say I pull up your credit report and I see you have 10 cards, but they're all super low balances. I can maybe tell you like, hey, transfer all those from now once I'll report your credit in a month from now once they're all on one card. And you might be able to qualify for more because now your debt is showing up as less when you still technically owe the same amount.
Yeah.
So like I said, that's one of the benefits of talking to a loan officer beforehand to try and get yourself prepared to be in that best possible scenario to move forward.
Okay. So we know what it takes to get pre-approved for a mortgage, what to do with credit cards. Before you apply for a mortgage, I would say, do not get a new credit card.
No, that definitely do not.
And do not buy a car.
Yes.
If your goal is to get a house and get pre-approved, that process should be held separately. Personally, in my opinion, you should get a car after your home.
I 100% agree.
Only that way you can get pre-approved for more and you can kind of see like where your budget is.
Yeah.
Because I think housing is better than, driving.
Yeah.
I think we can all agree.
I think we can all agree on that.
So there's those two. Now,
just to reiterate on what he said, if you're thinking about buying, definitely do not open up a credit card at least like 3 months before you start the process of buying. Because it's just gonna look bad on your mortgage because it looks like you're trying to find.
You're trading off more than what you can eat. So with that being said, the people want to know, Alex, what are the current interest rates for mortgages and what can I expect in the future?
So right now, it's between, I want to say 6 to 7. And it obviously completely depends on your credit score, your loan to value.
6 to 7 is a huge gap.
6 to 7%.
That's like, come on, Alex.
You
gotta give it to them straight. Like 6 to 7 is a huge difference. Like 6.5 to 6% is almost like a $200 difference.
Yeah. Okay. So So 6% is more on the FHA side.
Okay.
So FHA usually does have a little bit of a lower interest rate because, as we talked about in the last episode, it's a government-backed loan. So the government's willing to step up to it. So lenders are usually willing to give you a little bit of a better score. If you're looking strictly, so for FHA, we're probably around 6 to 6.5. Conventional wise, you're probably at 6.5 to 7.
Okay.
So, and as we talked about before, there's pros and cons with both. With FHA, you are going to have that mortgage insurance that you're going to pay for the life of the loan. Of course, you can refinance in the future to get rid of it, but you have to refinance to get rid of it.
Okay.
If you go conventional, you have a little bit of a higher interest rate to start off with, but that insurance falls off once you hit 20% loan to value, and you don't have to refinance, it automatically falls off. So, pros and cons to both.
Okay.
But that's about the ranges. 6 to 6.5 FHA, 6.5 to 7 conventional.
Okay, so 6 to 7 is kind of like we're expecting to be for a good minute. I would say anything further than that, I personally believe it's kind of like it's up in the air.
It's a coin toss.
It's up in the air just with how the economy is going. I do believe though at one point they will fall down.
100%,
sub 5. I don't think we'll ever see 3% or 2% again.
I personally don't even think we'll hit under 4.
Okay.
I think we'll see maybe low 4s in the future. And when I mean the future, I mean maybe 2-3 years from now. Low 4s, but I don't think we'll really see sub 4 unless we have another quote unquote black swan, which was COVID.
Yeah.
Because
and one thing we want to make sure to emphasize is that when this opportunity does come, when interest rates do fall down, house prices will go up.
Yeah.
It's just how the game works.
It's all a seesaw. It's a give and take.
Yeah.
As rates come down, prices go up.
So if rates come down, people have more purchase power. They can qualify for more. They can qualify, period. They can qualify because it's a lot less.
Yeah. And I think you kind of hit on it. If you give somebody $350K to borrow, what are they going to do? They're going to borrow $350K. So if that person now can borrow $400, what are they going to do? They're going to borrow $400.
They're going to use that.
So
they're going to use that gap. So that being said, that's where interest rates are at. That's where we see them going. I want to talk about a little bit how we're creating opportunity with these interest rates. Like me and Alex have been teamed up with a few clients. And for those clients, they might necessarily qualify for the most, 380, right? But they're at 350. Alex got them pre-qualified at 350. And the interest rate sitting right now at 7%. What we'll do is, we'll bring down the interest rate by buying down points, right? Buying down the rate, right? So we create opportunity to make sure that our client has the opportunity to qualify for more. So I don't know if you want to talk a little bit about that, how you do that, and on my end, how I negotiate it.
Yeah. So there's something called, buying down the rate. You pay points, and a point is 1% of your loan amount, and you can buy points to permanently buy down your rate.
Right.
And I've recently, like as a month ago, locked people in like the mid 5s, upper 5s, with credit scores being up in the 7, 6. So you're buying it down like over 1%, and at that point, like, you don't necessarily have to refinance. You can if rates come down low enough, but you're at a good position.
Yeah.
And for most of these buyers, they're not the ones buying on the rate. It's the sellers that are willing to pay for it. So and if you want to talk a little bit more about that.
Yeah, so you included in buying down the rate. So interest rates at 7%, right? Everybody's scared, they're freaked out. They're like, oh shit, like it's crazy. So 7%, but Alex here has the opportunity to bring it down by kind of charging the closing costs to the closing costs was buying down rates. Now, when you buy down a rate, it's going to cost money, but it's like a fee, so you don't have to see it later on in the future, right? You don't see it hit you on the back end. There's no catch to it. The catch only is that you're paying for it,
like upfront.
Upfront.
There's no.
Yeah, there's actually, I think there's a tax benefit too.
Yeah,
there really is. We'll talk about that. Yeah, so there's actually a whole tax benefit that includes with buying down the rate. But the point is, Alex will charge it to your closing costs. Your rate falls down. I know mine fell down from like a 6.6 to a 5.9 by buying down the rate. He included in the closing costs. I negotiated closing costs by adding seller's credit, and my seller ended up paying for that for me. So, I mean, I didn't end up paying for it. I qualified for more, and I got to buy down the interest rate. At one point, I wanted to refinance my 5.9% interest rate to where I'm going to get a lower mortgage rate. But now I locked in a good house where there's limited inventory. I got my seller to pay for my credits, and I got a decent interest rate. So.
Yeah. And that's another thing that I kind of wanted to hit on a little bit. But because, for example, when we talked about earlier, if you notice that when I said you're pre-approved, we approve people based on a monthly payment, not necessarily a mortgage amount.
Yeah.
So at $2,100, let's say your rate is 7%, maybe you're only qualified for that $300K house, but you're able to bring your rate down to 5.5. Now you're qualified for that like $320. So if you're able to have the seller buy down your rate, you can theoretically afford more home.
Yeah, increase purchase price.
Yes.
Gotcha. All right, so that's pretty much it with the interest rates, mortgages. Dude, we have like 10 more questions.
I mean, these are all good questions. Like I said, especially for first time, and I feel like we might be nerding out a little bit on this video, but it's really great information to have, especially as a first time homeowner.
Literally. So shout out to the people that shot me an IG question. How much money do I need for down payment? I think this was pretty quick and easy.
Yeah.
It is all case by case scenario. For FHA, you want to talk about those?
So I'll knock them out real quick. So FHA is gonna be 3.5% minimum across the board.
Yeah. So literally, just go on your iPhone or Android calculator, type in the purchase price easy on Zillow or whatever. If it's 350, type in 350 minus what percentage?
Yeah. So I know off the top of my head, for example, on 300K, it's 10,500. So on a 300K house, you would need 10,500 for down payment.
3.5 or 5?
3.5.
3.5%. So it's 10,500. You have the opportunity now that seller can negotiate with you, and we can cover some of those costs for you.
And I will say,
but that is kind of like the expectation.
I know for some people, and I'm just throwing it out there, I know some people that, like, for example, have a couple kids and stuff. They're after taxes, they're probably getting close to that like $10,000. So you can use that taxes like refund to try and fund your down payment this year. I mean,
that's great.
If you're really like trying.
Is that what you get?
I mean, we're not gonna talk about my taxes, but I do have 2 kids, so
I'm trying to make some babies. No, that's cool. I mean, it all like goes back. Like you probably spend more money than that.
I mean, kids probably kids cost more than
literally. Disney trip. Like that's like
but anyway, 8,000. So FHA 3.5%. Once we get to conventional, there's 2 options. if you're a first time home buyer and you make under 65K, there's something called Home Possible and Home Ready, where you can put 3% down.
Yeah.
So it's actually even a little bit lower than FHA. So it's 3% down, and there's something on conventional loans. There's something called LLPH, which is loan level pricing adjustments. Those are waived. So you're kind of getting like the bare bone interest rate. So you get a little bit of better interest rate. But like I said, the caveat is you have to make under 65K a year. If you happen to make more than 65K a year, then the lowest amount, or if you're a second time home buyer, like if you already have a home and you're trying to buy another one, the second one is 5%. So those are the three options: 3.5%, 3%, or 5%.
What do I need for down payment? It's a ballpark, anywhere from 10K up to 20K, depending up into the purchase price. Obviously, if you want to purchase price lower, like if it's sitting at 320, then the price goes a little lower. But with that being said, I mean, I'm not gonna lie, there is limited inventory, so there's like pros and cons. Like you only have so many houses to choose from. So just by keeping it real, like that's the catch. Okay, so that knocked out that question. I have another one right here. It says, what is a home inspection and should I get one?
So I'll actually let you take over this one.
Yeah.
Especially because as a loan officer and as the person that pre-approves you, a home inspection is not required. I can give you the mortgage. And
not even for FHA, conventional, but they do need to meet some standards.
We need home appraisals, which I think that's another question if I'm not mistaken, but... So there's so I'll actually let Caesar take over this, but there's a difference between home appraisal and home inspection. Right. Me as a mortgage person, I need home appraisals, like whether it's FHA or conventional.
Okay, this is a question. Then how do you know if either a conventional loan, let's say I want to buy a home, it's distressed, right? Let's just say it's distressed, but we don't know that based off of your end or a conventional loan because it needs to be in a livable condition. Yeah. So how
the appraiser will tell me that.
So they will tell that from the outside.
The appraiser goes inside the house too.
I don't think I got the inside appraisal. It was just like it was all pages of comps.
No, so they do comps, and that's like the main way they do the appraisal. So like again, it might get a little geeky here. There's two different types of appraisals for FHA and for conventional. For FHA, the appraiser has to be certified to do FHA appraisals because those have to go a little bit more in depth.
I think inside though?
Yeah, like we touched in last time. They have to have like smoke detectors. Yeah, they have to make sure that things are in a livable condition. Okay. So yeah, FHA, there's like a case number assigned. The appraiser has to be an FHA certified appraiser. Like there's more steps versus a conventional like. He basically comes in as long as the house looks like it's not, and I don't want to put it that way, but as long as the house looks like it's not, beat up and falling apart, and the other comps around support that price, then we're willing to lend on that.
He's good. Yeah. So, well, that's good to know because I honestly thought that an appraiser just like kind of did zoning, they did comps, they looked at the outside of the house, the back of the house. I didn't even think they walked inside. No,
they go inside,
but I should have looked at my appraisal report.
And obviously, as somebody that owns a home, like I'm saying right now, loan officers don't require you to have they require to have an appraisal. You're not required to have a inspection. Right. But as somebody that owns homes, I 100% would say get an inspection.
Yeah, of course. And so this is like realtor. This is like very very important. I highly suggest that anyone gets an inspection report because you don't know what you don't see. So there's been a lot of homes that have internal issues rather than just cosmetics. For example, the last inspection that we just had on the last transaction, they had something to do with the dishwasher, right? The dishwasher looked perfect and everything, but when you walk in and tour the house, you don't really sit there and do 2 loads of dishes, right? And so the dishwasher is gonna run itself when the inspector comes. He's gonna run it. He's gonna be like, okay, is it work? Does it not work? At the end of the day, it was leaking. Cool. There was a specific crack that was had an opening in the bathroom, and so that's something that I did not notice, right? you kind of, when you're kind of like looking at your homes and putting offers down, you're looking at multiple homes, right? And you don't remember everything. And even then, like if you record and to show to your like your significant other or your mom and dad the home that you're looking to buy, the camera doesn't capture everything.
And like you said, there's things behind the walls like plumbing or like electrical things.
Yeah.
You can't see those from a picture or just a.
Yeah, definitely. So the inspection report is really important, just to know that what you're walking into. If you want to anything after that, like it's game time. Like once you get the inspection report back, this is the opportunity for you to either back off, and make sure you collect your earnest money deposit. The earnest money deposit is something that's not refundable
past a certain
time. So after the inspection report, you're still in that time of essence for you to pull out. So that's why it's really important, because you want to make sure where you're getting yourself into. Mm-hmm. But also at the same time, the inspection report comes in clutch when you're negotiating as well. So I know for the past transaction, we negotiated seller credits, right? So stove didn't work, right? Mm-hmm. So I asked the buyer, like, what was up with the, because at the end when we closed so the seller got like $500 in seller's credit just for the stove, because the stove did not work properly. What I meant was when you turned it on, like the fire wouldn't come out, right? Mm. So, and all it needed was a cleaning. The people before didn't know, but at that time that the inspection, it wasn't working. You needed to actually put fire for it to light up. Mm. And so just with that, I mean, you could save yourself $500 headache. With it, you can buy a new stove, and that way come in with a new stove, and that's,
and I will say this, like inspections are probably $400, $500.
I mean, it's less. Like anything from around 1,500 square feet to 1,300 square feet is like $200.
Okay, because I know, like I said, I deal more with appraisals on a daily basis, so appraisals are between $500, $600. I honestly thought inspections were about the same. No. But you get your money's worth. Like I feel like at least 80% of the time, the inspector is gonna find something that might not even be actually wrong with the home, but it's just going to be a quote-unquote defect that you can go back to the seller and be like, hey, there's this defect. I need seller credit, something back in return. Yeah. We can move forward.
So at the end of the day, inspection report just comes really clutch. It's something I suggest everyone should do. If you're not doing an inspection report, literally the time where everybody is outbidding each other, that's the only time what I would say that if you want to risk it all and not do an inspection report only to get approved, that's just times of desperation, though. That's what people were doing a year and 2 years ago.
During COVID. Some people were waiving inspections.
Appraisal, everything, just so they can get the offer approved. But now, I mean, everyone has the time to really look thoroughly and know what they're getting themselves into. So,
and just a little tip too. I don't know if a lot of people know. You're allowed to show up to the inspection. You can walk through the inspection with your inspector. Yeah. So if some people don't know that, they might think you have to hire them and let them do their thing. As long as you're not bugging them and asking them 100 questions, you can kind of just follow walk the home with them.
That's really what I do.
And they'll point out things. They'll be like, oh, and they'll still give it in the report. So don't worry that if he tells you it's not going to be in the report, but at least he can point it out to you in person and you can see firsthand what he's talking about.
Another thing that I like, one last thing would be that, there's some things that might not even be wrong, right? But there's certain things, for example, the gas meter, right? Mm-hmm. The gas meter, after 10 years, you're supposed to replace it because it's just it's bound to go bad at one point. But most of them last 15 years. Mm-hmm. And so the gas meter that the last inspection had was getting closer to 10 years. So only because it was old and it was functioning perfectly, that's something that we included in the inspection report. And the inspector actually put gas meter is getting old, literally. Yeah. And so because of that, we can use that section from the inspection report, place it in the repairs report.
Use it as leverage.
And use it as leverage for more credit. I mean, I'm not telling you to hustle, but this is your big purchase. You want to maximize every single penny that you're using. Yeah. So it's a ball game. It's up to you. You're not doing the seller any bad, because at the end of the day, they're selling their home and you want to buy it. You guys made a mutual contract. So go for it. I would tell you, Yeah,
I would always say do an inspection 100%.
Okay.
Even though it's not required, 100%.
That was a good one. That was actually a good one.
You can
Yes,
do like one or
so
two.
what is a home appraisal? You want to do that one?
Well, no, because
Is
we
there
kind
a
of
specific one?
already hit on that. So we
What is a
can-
private mortgage PMI?
We've
Do I
already
need
kind
it?
of talked about
What
that.
should I consider when choosing neighborhood? How long does the home buying process typically take?
We can kind of
We can talk that. What is the difference between a fixed rate and adjustable rate mortgage? How can I improve my chances of getting approved? We don't need that. What happens if I miss a mortgage payment? You shouldn't. What are my options if I can't make my mortgage payments? Yeah, that's dumb.
We can just hit on the
little
process. What was the second one?
How long?
How long is the
How
process?
long does the
and
home buying process typically take? We can talk about how people sleep on like the amount of time it takes because they first have to get pre-approved through you.
If you want, I can hit on the fixed and the adjustable.
And then the fixed, and then
super quick because it's going to be like 2 minutes.
Okay.
If that.
Literally, these are all yours now.
Okay. So one of the questions that somebody asked is, what's the difference between a fixed rate mortgage and an adjustable rate mortgage? And I'll just go through it super quick, just especially because adjustable rate mortgages are not super popular. Basically, fixed rate mortgage, as we said earlier in the video, your payment is the same for 30 years, doesn't change. Adjustable rate mortgages, they're called ARMs. And there's different ARMs you can do. You can do like a 7-year, a 3-year, 7-year. So basically with those, your payment's the same for either the first 3 years, the first 5 years, or the first 7 years. There's even 10-year ones. And then after that, it changes either every 6 months or every year, depending on which contract you go with. The benefit of those up front is they usually come with a little bit of a better interest rate since your payment is not the same for the rest 30 years. But the downside is after that first 3 years, your payment can start skyrocketing, going up and up and up. So that's why they're not really popular, because people want to be secure. They want to know my payment's not going to change. Versus, oh, cool, I got a little bit of a lower payment for the first 3 years, but then 4 or 5 years down the line, your payment went up, $400, $500.
So 30-year fixed rate, keep it
It's
as
like,
the same.
And and the arms are there for people. Like, if you're somebody that knows you're going to, for whatever reason, leave and you want to sell your house within the next 5 years, and you know that to be a fact, I'd probably recommend at that rate, like, do a 7-year arm. That way you're still giving yourself an extra 2 years and you get that better interest rate because you know for a fact you're going to be selling this house within 5 years.
Yeah.
But most people aren't. They're going to sell their house.
Yeah, so 30-year fixed rate arm. Arm, you would say to only use it if they're not going to live in it for more than 5 years, right? Or they're going to sell it within 5 years. So that's the way to go. Fixed rate, I would say if you're either, if you're keeping it or staying in it,
investing it, buying it for yourself,
Airbnb it, renting it, stay with it because that's what you need to pay every month.
Yeah.
Copy. Okay. So, that was a great question. Like, I know adjustable rate mortgages are kind of like what happened with like 2008 type. 2008 housing market crash. Like a lot of people bought into like
teaser rates. It was called teaser rates.
All these homes thinking they got approved for a certain amount only because they fixed the mortgage payment was only like, let's say $500, but on year 5 they raised to like $3,000. So they kind of like messed people up and just like approved everyone for any home. Gotcha. So last questions that we had, I would say, how long does the home buying process typically take?
So I can start that off and then you finish it, especially because that's kind of the process works. You kind of talk to me first and then you would talk to Caesar.
Yeah.
So with me, it just really depends on how quick you are to give me your documents. The way I first do it and the way I originally do it is...
I'm not the problem.
So I have I like to talk to people, kind of get to know their like goals and plans. Like, what are you looking for? Price point, monthly payment. Once I see that it's like something that's like viable and stuff, then we kind of start going deeper into doing the actual like pre-application where I ask for your pay stubs, your bank statements, I have to pull your credit report. That's where I do like my nitty gritty basically and get down to the details and I get you pre-approved. Once you give me all the documents, I can honestly probably have you pre-approved in a day, 2 max. Yeah. But it's up to you to give me all the documents. Like in it, I need like, for example, 2 months of bank statements, for a lot of times 3 pay stubs, 2 years of W-2 forms.
These are things these are a lot of things that people don't know that they should keep.
Yeah,
like and a lot of people just don't know. Like,
and so that's why it does
stored somewhere.
Yeah, and so that's why it does take a little bit longer because sometimes they'll give me like almost everything. They'll be like, I can't find my taxes from last year, so I gotta request a copy, and that takes a week to get here, and so then it takes me a week to pre-approve you.
Yeah,
because
and that's a whole other process. Like whenever you do your taxes, just for future reference,
Keep copies.
Just keep a folder stored. Like I buy like a little binder. Just store them in there, and you'll be fine.
I personally have a Google Drive, and obviously, like I want to continue buying property, so I have a Google Drive that has all my documents. And every year when I do my W-2s, I upload the new ones, and just I keep that folder like updated. So when I'm ready, it's already set to go.
Yeah, same. I kind of have I don't have a Google Drive. That's smart though. I should have it because if my computer just
especially
crashes
nowadays, people
something.
send everything to me like electronically. So that was just an email. You just upload it and send it.
Yeah. So I should put that on Google Drive.
Realistically, I want to say it probably takes a week to 2 weeks to get you pre-approved.
I like,
and it's like I said, it's a lot of it is based on when you can give me the documents.
That's just like pre-approval. So
that's just like the start.
A week, 2 weeks. I would say house hunting is like the most like important step. That's like literally like the most crucial step. Everything else is a breeze. Like once you know the house that you like, you get an offer approved, then we have exactly 30 days.
30 days. Yeah.
We have 30 days to close.
So if you think about it, that's already 2 weeks up front, 30 days at the end, and then
I would say a month and a half, right? But viewing houses right now, there's limited inventory, so looking at these houses, there might not be a lot of houses that you like, so you'll be a little picky, and then there's some you'll fall in love right away. So it all depends on what you're looking for, what area you're looking for, what features, what desires, what are must-haves, right? If you want a 3-bedroom, or if you really must have a 4-bedroom, those are all differences that make up like how long it's going to take to make sure you find one. So once you find that one, we have to put in that offer. So that's where it's like you'll get it approved or you won't get it approved. So what if it doesn't? There's situations where it won't get approved, right? Only because there's someone that just happened to have more of a purchase power than you did, and when that comes, it's back to square one. We got to keep looking again. But it's not the end of the world. There's houses out there. There's gonna be one for you, and I really like how it's like it's just if it's meant to be, it's meant to be. Yeah. There's a lot of houses that I put in offers, right, and not all of them got approved. And like you remember?
It was actually perfect.
Yeah, it was like really. This is crazy story. That was a crazy story because there's this like house that I put in an offer. It wasn't the best looking house. Yeah. It was like 2-story. That's the only thing I liked about it, and like the outside looked nice and everything. It was really nice outside. Inside was kind of like small. But it was like a perfect market for me to lowball offer, but I didn't lowball offer because I was asking for I think a lot of seller's credit. So the house was listed like normally I only put in the offer like $5,000 below, and they rejected me.
Offered. And I remember even looking over the offer, and I'm like, dude, this is a super reasonable offer.
And the house was like on market for like 90 days. Like not every time you're gonna get it, but if it happens for a reason. So that's my message here, and I really want to emphasize that because
right after that offer, that's where you got.
I literally offered $25,000 under asking price. On top of that, like over $10,000 seller credits, and that one got approved so fast.
Yeah, I remember you told me you were like, hey, I didn't think I was gonna get it. I was just going for it, and literally it got accepted.
I remember it too. I'm like, this is a nice house. It's been there for a minute. Like, let's see what happens. Yeah. Entered it, sent it. 2 days later, the realtor was actually kind of like pissed. Like he was like, hey, I'm like, here in California, like, your offer got approved. Yeah. I'm like, are you serious? He's like, yeah, like the sellers just want to move fast with it, and so it's just the time. It's literally comes down
like
to
it's meant to be. Like if it's
God's timing, your timing, everything just makes sense, and everything happens for a reason. So at the end of the day, the process is going to take probably over a month and a half. It takes a month after you get your offer approved, a week or 2 weeks to get pre-approved, and then that home hunting, it's all up to you and timing and just fate and God's will. So,
and I will say, at least once you have the offer accepted and everything, like you said, the standard contract is about 30 days. Yeah. If me as the lender can get everything done beforehand, which a lot of times we've been getting cleared to close like within 2 weeks. You're able to execute that contract and close early if you want to. So if you're like really excited and you want to move in, once we have that clear to close, that means that me as the lender and everybody on my side has done our due diligence, everything checks, and you're good to go. If you want to wait out your contract, then for whatever reason, you're more than welcome to. It's in your contract, but you can close as early as 2 weeks.
The only thing I could think of is like why you would take a little longer and not close before would be like waiting to see if the interest rate might like go up and down, and then like you can lock your rate, then be clear to close. That's one of the things that we've experienced a few times. So I mean, with that being said, that's kind of like what the home buying process is kind of like, and how long it takes. So kind of expect that. And in the meantime, I mean, you still have those kind of like 2 months to like save, or move money around, do whatever you need to do in order for you to be in the right place for you to make this move. So you'll be all right. We'll take care of you.
And so with that being said, I want to thank again everybody that sent in questions. Thank you for listening to us, subscribing, liking the video. Tune in for the next one. So
please, like, subscribe, share
it.
We're here for you. Any other questions? And thanks for keeping it real.
See you on the next one.